Friday because I was referring to my old grading standard. I do a more fair grading standard these days. I used to do a higher stakes final paper in this class, and that's where my thinking was stuck. For the midterm grade, what I'm going to be basing it on is 50% test, 50% homework. So it's a 50-50 split. That means people who are good test takers, for example, get an equal shot with people who are not. Your final grade, however, it's going to be 45-45 with a stock game in the middle. We're going to be covering the stock game this week to get you guys in. I did not get a chance to read your chapter 3s yet. Therefore, because I have to post midterm grades today, I will not be including chapter 3 in your midterm grade. I have every reason to believe that you all did well. I shouldn't say next Friday, I should say this Friday there is no class because it's mentorship day for the School of Business. So all business classes are canceled for Friday so that you can participate in mentorship day. Unfortunately, this year we have to do it virtually, but there's still value in mentorship day. I put a link under chapter 16. If you sign up for a mentorship day session and you submit proof that you registered, I'll give you 2 points on your next test. So please sign up. Guys, we always hear the expression, it's not what you know, it's who you know. My answer is it's both. But you got to have that foot in the door. We have a really powerful alumni network, and most of the people who are coming to these sessions are people not much older than you guys. People who are already making successful careers. It's a good chance to get connected. So please, in fact, I'm giving you permission during this class, because those sections are filling quickly. I sent out the email last week. If you have not yet registered for a session, pick one and sign up. Again, all of your business classes will be canceled. Give me proof that you signed up, a screenshot, a registration, whatever, 2 points on the next test. Speaking of bonus points, guys, I took the following approach because we have quite a few people in here who got bonus points. If you got a perfect score on the test, I saved your bonus points for you. If you requested that I save your bonus points, I saved them. Otherwise, I applied them. As a result, we had a lot of people move between grades. We had people who went, from a B plus to an A minus or an A minus to an A. Those bonus points really add up. So please, if you get an opportunity for bonus points like this, take me up on it. So let's continue. Guys, here's what the plan is. Today, we're going to be starting on chapter 16. The last 2 online Fridays, we started covering the securities market a little bit. By securities, I mean stocks and bonds. We're going to be giving you context this week in terms of how companies raise money and the purpose of stocks and bonds in the first place. So today, we're going to be picking teams. We're going to be breaking into groups of 3 to 4. You guys, by the end of our session today, are going to be emailing me the name of your team. Now, we have some folks who are not here today, so here's what's going to happen. Some of those folks may be randomly assigned into your teams as well. We'll be covering all of this stuff. Now, on Wednesday, I'm going to cover the game in detail. We're going to break into your groups, and I'm going to give you guys a copy of an A-grade final project in this class. So you're going to get to see what does it take for me to get an A on this. Do you have to make money in the markets to get an A? You can, pardon my French, you can lose your ass in the markets and lose everything. And you tell me why it happened and how it happened, and if your strategy worked out or didn't, you can still get an A. I don't care if you make money. What I care about is you get a chance to play with the markets. I'm also going to be showing you how to calculate what we refer to as a rate of return. Now, for any of you who are accounting or finance majors, this is really simple math. This is not stuff that's going to be complicated, but it's the ability to be able to show whether or not our portfolio is making money. We're going to be talking about things like you want to diversify your portfolio, for example. So the guiding principle for Chapter 16 is to think constantly, if you had $100,000 to invest, what would you do? I heard some great feedback on Friday, by the way. Some of you guys were saying real estate. For those of you who picked real estate as an investment, why'd you pick that? Because I thought it was a pretty good investment. Yes, Nick? And we're not creating any more planet. We've got a limited sized planet. If you own a piece of it, it's probably going to appreciate in value. I love it. Some folks also, by the way, this was a sleeper, but it was a good choice. Some of you picked utilities, which is a really good and interesting option. Why are utilities a good option in terms of buying stocks or investing? I'm going to go back here to page for this one. Nick, you know it too. Let's see what we got. We're always going to need them. And Nick, you have anything to add to that? That's exactly right. People need them, and there's very limited supplies of these things. So for the entire month of October, our stock game is happening. You're going to be playing the markets. When we get in here on Wednesday, I'm going to show you how to monitor your portfolio. I happen to use an aggregator called Yahoo Finance. I know Yahoo is not a big name in search engines anymore, but their finance piece is still pretty legit. It absolutely is really good for monitoring, and it'll do a lot of work for you. So what we're going to be doing at a certain point in class today, I'm going to be breaking class. We're going to be pausing class. What I'm going to be asking you to do is to assemble in groups of 3 to 4. The answer is definitely not on your phone for this one. Please, guys, put your phones down. We're going to be covering this in detail so you can get a really good grade on it. But I'm asking you to form groups of 3 to 4 members and come up with a creative name. You don't have to have an investment strategy yet. You don't have to have any idea what you're investing in yet. All you need to have is a team name. Keep in mind, if you form a group of 3, you may end up with an additional person in your group. If you like to write, you're a valuable team member. If you like math, you're a valuable team member. Who here is actually actively playing the markets by show of hands? To me, these are MVPs already. You got people who are already playing the markets. I would want those people on my team. So we're going to be jumping into chapter 16. Guys, what is this all about? Guys, why do companies take out loans or issue stock in the first place? What might be a reason that a company would go public? Yes, sir. I'm sorry? They can grow. They can raise money. Absolutely. We can make our company bigger. Some people going public, having what we refer to as an initial public offering, it's a prestige thing too, because you can say we're a publicly traded company, but it's a quick way for us to be able to make money. So we're going to be talking about what the ways we can do that are between stocks and bonds. We're going to be talking how those finances get used. First of all, we're going to get that in context, why we would do it at all. We're also going to talk about the differences between debt and equity. Debts, loans, equity, stocks, and what the major features and advantages are. We're basically going to talk about how this stuff plays together. Then we're going to talk about how people like you and me can get in the markets and why we should. By show of hands here, how many of you have ever heard your parents talk about managing their retirement? Yeah, guys, in the United States, the government does give us a little bit of retirement. They give us something called Social Security. How many of you believe, based on our discussions, that Social Security will be around for you when you are older than me? Yeah, I don't believe it's going to be around for me either. What this means is that you and me and all of us, we're in charge of our own financial future. How many of you, by show of hands, hope that by the time you hit 65, that you can retire? Yeah, me too, man. I'm with you guys. Don't know if it's going to happen for me. Might be closer to 70 for me, but probably because I want to keep working. So how does money move through a business in the first place? Well, first, if you're actually making money, if you're selling stuff, if you are providing a service or selling a product, and you're making money, that cash comes into your company. That's wonderful. Well, when you're first starting a business, somebody's got to put the seed money in. That could be the owners, for example. Does anybody know how Jeff Bezos got the money to start Amazon? Where did he get his capital to start? Anybody guess? I'll give you a hint. It wasn't a bank loan. Yes? His parents were rich, man. So he got some money to start off Amazon from his own parents. And that happens a lot of the time. Boy, it can be rough when you borrow from family. You better be able to pay that money back. You can also sell stuff that's worth something. For example, if you're REI, after the pandemic, you decided you don't need your big headquarters in Seattle anymore. You're going to sell that and make some money to put back into the company. Collection of accounts receivable. That means people have bought things from you on credit and they owe you. Well, this money goes out of your company in all kinds of ways. You got to buy stuff to do your job with. You got to buy fixed assets like buildings. You got to pay your expenses. What's the most important what's the most expensive thing that a company constantly has to pay for? Labor. You got it. People. We also are the most complicated and hard to deal with part of it. If this computer breaks, you can fix the computer, right? People are hard to fix. People are tough. People are complicated. So all these things are expenses for us. Then we got payment of dividends. If you're issuing publicly traded stock, you have to pay a dividend. Actually, you don't have to pay a dividend. It's not a legal requirement, but you want to keep your shareholders happy, you will. We're going to talk more about that. And then you got to buy inventory. This is all the way that money moves through a business, guys. So the root of all this, if you like managing money, You might have a career waiting for you in financial management. This is the person or people who decide how money moves through an organization. Let's put this into context, guys. How many of you are Wawa fans? Okay, you're okay. I like Wawa people too. How many of you are Sheetz fans? It's okay. I'm not putting judgment on anybody, even though I got a Sheetz cup of coffee up here today. Does anybody remember when I said, this was about 2 weeks ago, for every dollar in revenue that Sheetz pulls into their company, how much was it, guys? Who knows? It's 1 cent. What does that tell you about the way Sheetz values reinvestment in its own company? Exactly. Do you know what Sheetz' unofficial mission statement is? We want to be the company that will put our current version of ourselves out of business. We want to be that innovative. So they reinvest in their company. Now, not everybody can afford to do that level of reinvestment, but that's a strategic priority for Sheetz. That's the way they run their company. So some of the things you have to think about, for example, what is your strategy? If you're Sheetz, you want to grow. You want to dominate. You want to get your stuff out into other places and set up shops. If you are a different company, you may have a different strategy toward long-term growth. Even the way you compensate people, guys. If we have two companies, one company, for example, is BMW, and the other company, say, is Ford Motor Company. They have different compensation strategies. If you're BMW, you don't discount your product. People who work for you can probably make a lot more money, even if you have a slower growth strategy. So what does the finance manager actually do? By the way, by show of hands, how many of you are accounting or finance? Great majors, by the way, guys. Everybody needs accounting. Guys, in terms of financial planning, what you're trying to predict is what's going to come into our company financially versus what is it going to cost us to get that stuff out the door. Has there been something this year that has made this kind of prediction very difficult? What is it, guys? Yeah, go for it. COVID, we're all wearing a mask. Could you imagine, guys, on the positive side of things, if you're Amazon, this is like the greatest thing ever. Everybody's at home and they got nothing to do but buy stuff from you. Buy everything from books to toilet paper. It's great for you. Who has COVID been terrible for? I'm sorry? Airlines. By the way, guys, that's a great point. In the last week, the airlines started laying off people, guys. Do you know how much air travel is down since March? It's what the total percentage. We're down 79 to 80%. What business can survive that kind of drop off? So airlines, for example, are like, what the hell? Who else has been hit hard by COVID? Cruise lines, for sure. Nobody's taking cruises. Disney, yes, go ahead. Exactly. Remember how we talked about how there's a recovery on top of a depression? People who are laborers, for example, or who work entry-level jobs have been hit. Disney just laid off 28,000 people. 28,000 people lost their jobs. So if you were Disney and you were planning on expanding this year, you got to change your strategy, but quick. So it comes down to that as well. So we're going to decide how we're going to invest. If you're Amazon, for example, I use them as an example because they're such a big company. Have you seen their commercials lately? What are they investing in, guys? What do they say their big investments are going to be for the next 10 years? Absolutely. So we're Amazon, for example. In the old days, when we started off, here we are in Seattle. We have our warehouse here. If you wanted to get, like, this is this goon, his last name is Tonkin. This guy, check this out. This guy's 47 years old, and he's like obsessed with action figures. He's all this Batman stuff all over the house. There's something wrong with this guy. I mean, he needs some help, maybe a brain transplant. But he's always ordering stuff from Amazon. Back when he started this bizarre obsession with Batman, and let's say it was about 1999 or 2000, how did that stuff make it to his house? Postal Service. So he had USPS, or he had FedEx, or he had any number of shipping companies. If he lives in a big city now, who delivers that stuff to him now? They own their own distribution. They've decided to vertically integrate. That means that that was a priority. They're going to reinvest into their company. And as a result, people like the Postal Service and USPS are less important than them before. Yes, sir?
How long until like the become a real thing for them?
I really don't know. I think the tech is there. The bigger question is the regulation, I think. Because we're already starting to see in big cities same-day delivery for Amazon. Drones are going to take that to the next level. But my point is, if you're Amazon, you're reinvesting. They're actually doing their own energy. If you work for Amazon, for example, you get your health care from Amazon. If you get sick on the job, you go to a video conferencing unit, and an Amazon employee who's also a nurse is the person who screens you. They own everything in their own system. That is their priority. And how did they do it? They have great sales, number one, but they also have what we refer to as equity. And we're going to talk about what that means in a minute. So if you're the finance manager for Amazon, your priority is not just paying people and getting by. Your priority is reinvesting in the company. Other companies have different priorities. So what do we have? We got short-term. We got short-term stuff that we need to think about. Operating expenses. You got to pay people. You got to keep the lights on. You got to keep the factory moving. That's short-term. We also have to think about what we can sell in a year. Liquid assets. If you say this is highly liquid, what that means is we can turn it into cash inside of a year. I really need to take a seat back here for a minute. It's just, I wonder what it's like to sit here and listen to somebody talk on Monday morning. What's it like? I don't know if I believe in this guy some days. Throwing stick figures up on there. He's 47 years old, man. How did he make it this far? His wife probably asks that every day. I bet she sometimes thinks, man, maybe this will be the day he doesn't come home. I'd probably be like, she'd be probably doing cartwheels. Nah, my wife loves me. All right, I mean, his wife loves me. I just had to see what the view was like out here. Sometimes it's nice to see what the skies look like out here as well. So in terms of cash management, means you got to have enough money on the books to pay the bills. If you have not been paid yet for something that people owe you, if you want to collect the receipts that are due you, that's called accounts receivable. And then we got inventory. Guys, if you're sitting on inventory for too long, it's not a good thing. Inventory is bad because it's sitting there costing you money. You guys remember, by the way, back in, this would have been about March or April or May of this year, we talked about negative oil. Does anybody remember when oil went into negative trading territory? What was that all about? Dick?
We had an absolute surplus of oil, so we were selling it for less than it cost us.
Because it was costing more to store it than it was to sell it. You're paying more money to store it than you can make by selling it. That's whenever you get into bad territory, which means you got to get your inventory out the door. Again, these are all short term. And then we get into long-term stuff, and we're thinking about capital expenditures. Write this down. Capital expenditures. Please write this down. Capital expenditures. Please write this down. Capital expenditures. That means you're putting your money into things that are going to take more time to grow. It means that 1 year is not going to reap any benefit. You're doing big construction projects. If you're changing the way that you do your business, for example, Amazon wants to control their own power grid. That's a big investment. So that is a capital expenditure. It means you have to budget years in advance. A lot of people who are planning big capital expenditures this year have really had to rethink it based on what's happening with COVID. So remember, that's a capital expenditure. We need money to do things in companies. There are lots of ways we can raise that money. If you got good credit, man, you can get what we refer to as an unsecured loan. That means you can walk into a bank and they will say to you, hey, you look like a good risk. You have good credit. You're going to get this loan at a fantastic rate. We're going to give you 2%. Can't talk it on the other hand. We don't like the look of you. You're going to be paying 15%. You're going to get an unsecured loan. Accounts payable basically means you are buying stuff on credit. And here's the trick. Companies do it all the time. A large percentage of companies in the United States go through feast or famine. For the retail sector, we are moving into the part of the year where it's a feeding frenzy for retail. What am I talking about? Why are retail? Yes. Black Friday, Christmas, right? And here's what's funny. Black Friday just got, about 3 years ago, surpassed by Cyber Monday. But it's still a big deal. Some companies, guys, budget like 20 to 30% of their revenue for the year on freaking Christmas time, guys. Could you imagine? Right now, if you were in traditional retail, would you be afraid? Nick, why? I would too. Why would you be afraid? I think you're right. And here's the other thing that we're also predicting is that basically because everybody's going to be buying online. I heard this from somebody who works for UPS. If you plan on doing Christmas online this year, make sure you order early because shipping is going to be crazy. Here's one of the other problems. With all these people who want all this stuff and the system simply can't keep up with it because more people have migrated online. But I digress. If you're buying supplies, it's accounts payable. Bank loans means that you can get a steady line of credit from a local bank. I need to make payroll. You got a line of credit with our bank. We know that when you get back to the good times, you'll be able to get yourself back in shape and pay this off. And then we also have something called commercial paper. Here's what this means, guys. It's essentially an IOU. If I have a company that makes bicycles, and my buddy is an aluminum supplier, he can give me an IOU, what we refer to as commercial paper. He might give me a lower rate of interest on what the value of the inventory I'm getting from him is on the contract that I will pay it back. Here's the other thing too, guys. The contracts have to be written down to be contracts. You can have a verbal contract too. Although the 3 rules of business are write it down, write it down, write it down. If you are doing something like that, it's always good to have documentation on paper. That brings us to the crux of our discussion today, guys. Debt versus equity. I'm going to list a couple of things for you, and I want you to tell me if it is debt or equity. Borrowing money from the bank it's debt. Living on a credit card is debt. Getting people to invest in your company through an initial public offering of stock is, you got it. Here's one where it gets a little complicated. Who here has ever seen the show Shark Tank? Oh, Shark Tank is awesome. Whenever the investors are looking at these great ideas, what is something typical? What do they always want? They want shares in the company. They want control. And we call those folks venture capitalists. That's a form of equity financing where they're giving you money to do something with your product, but it comes at a price. So that is equity financing, but it's dangerous. So let's just, we're going to skip the review for right now because we are going to be getting back into that anyway. What is the primary difference, guys? If we go between having a loan and issuing stock, what is the difference to the company? Yeah, go ahead. For sure, we got to pay back. We have a loan, we have to pay it back with interest. Absolutely, that's a legal requirement. So that's one of the aspects of going into debt financing. Go ahead.
For equity financing, instead of paying that interest, are you getting the interest back to yourself if you invest in it?
You definitely can if you get shares and you get dividends. So you're absolutely correct. Here's the difference. Right now, this is Company A, this is Company B. Company A, you guys chose to issue a bond. You borrowed money to expand your company. Company B, you guys decided to issue stock to expand your company. You both want to do long-term investments. You want new fixed assets. Company A, you guys have debt. You took out a loan. Can anybody tell you how to run your company? No. You guys, you borrowed the money. You got to pay it back. But nobody can tell you how to run it. Company B, you guys had an IPO. You got into the stock market. Can anybody tell you how to run your company? Yeah, Maxwell, how can they? You got it. The more shares, for these folks, every person who owns a share of their common stock has one vote. Meaning, if somebody owns 52% of the shares in their company, for example, they can sway elections in the company. They can set the board of directors. You are beholden to your shareholders. Company A can do whatever it wants. Company B is beholden. Well, here's the downside. Company A, do you guys have to make loan payments? Yeah, unless you want to get foreclosed upon, you're going to pay with interest. Company B, do you guys have to pay dividends to anybody? No, you're not legally required to pay a dividend. And a dividend, by the way, means when a stock increases in value, you as the company can choose to pay people out or not. So we've got different levels of control. When this loan is paid off, can anybody hold anything over you guys? You're free and clear. You guys have your company outright. Until you buy those shares of stock back, guys, somebody else is in control of your company. That is the big difference between debt and equity financing, guys. That's the difference between stocks and bonds. I'm going to pause for a moment for our first question of the day. What question would you like to ask on this Monday morning, where it's rapidly turning into the cold part of the year? What questions do you have? All right. Well, that being said, we're going to continue then, guys. We're going to hit a couple more slides, and then we're going to break into groups. So stay with me, guys. This kind of summarizes right out of our text, for example. And debt financing, basically, if you're taking out loans, people can't tell you what to do. You can make your own decisions. And equity, people who have common stock can vote, and they can decide who's going to be your board of directors. If you are financing with debt, for example, you still got to pay your interest back. You got to pay your loan back with interest. But here's one advantage. If you're paying interest on a loan, it's also tax deductible. Does anybody know what that term means? For my accounting and finance folks, what's tax deductible? It means you claim it on your income sheet to say, this is something that counts so that we don't have to pay taxes as high as we would have. We can claim it as credit. In other words, I shouldn't have to pay tax on this stuff because I'm paying on a loan. If you pay a loan to the end, you're going to pay the full interest. You might be able to pay it off early. And tax deductible interest on loans makes sense. If you are getting dividends in a corporation, you're typically getting stock that pays back. You're getting taxed twice. So let's talk about what this actually means, guys. Write this term down too. If I say securities, the securities market is stocks and bonds. So if you're buying a security, you are buying a stock or a bond. If you buy a stock, you are buying a share of a company. If you buy a bond, you're essentially lending a company money. That's the difference. Which one is guaranteed income? If you're the investor, which one is guaranteed income? A stock or a bond? Yes, exactly correct. Because a bond legally has to be paid back. A stock might never pay dividends. And again, the benefit to the companies is these are both ways to raise money. These are ways we can expand our companies. The advantage to you and I personally is we can play in the markets and we can make money. I'll give you an example, and we're going to be covering all this stuff. But right now, every time I get paid, my company takes money off the top of my paycheck. I think right now I'm investing about 7 or 8%. So 7% of my paycheck goes to TIAA-CREF. And that is the company that manages our retirement fund. What they do with that money I invest, and I'm matching an investment from my employer, they invest that in the stock market on my behalf. So the money I put in gets to double or triple or go completely down the tank, depending on what the markets are doing, and that is my retirement plan. I have other investments as well. I have a diverse portfolio. I'm investing in several places, but this is what I'm doing for retirement. And so what you guys will need to do once you get into the working world is also take control of that as well. I'm going to encourage you, when you get your first job, they will enable you to join and start your retirement plan. You may say to yourself, I don't want 7% of my income going away. Well, maybe it's not 7%. Maybe it's 2%. Maybe it's 1%. Maybe it's 3%. If you start off and you invest that, you'll never miss it. And here's the other part of it too. Let's say, for example, God forbid, that somebody came in and said, Tonkin's a terrible teacher, we're getting rid of this guy, and they fired him. It could happen. It could easily happen, depending on the day. Well, that retirement fund goes with me to my next employer. And that's why we have them set up as 401ks and 403bs, which we'll talk about more in your finance classes. Yes?
So with like your 7%, if that did happen, you had to go somewhere else with that boss or whatever, would they have to withhold that 7% or could they change it or how does that work?
I think the top you can actually withhold, and don't quote me on this because I haven't looked at it in a while. I can take up, I believe, to 14% of my income and invest tax-free. And so that would be a matter of when I went with my new employer, setting that up from the get-go. This is how much I want taken out of my paycheck.
So it must be like starting over, like you don't have to do that again.
All the money that I have already invested comes with me. And here's why we did that. In the old days, companies had pension plans. And what happened to a lot of those companies? Well, the pension plans went bankrupt. That's one. And number two, if you got fired, you lost your money. And so this is set up so that we can take our pensions with us wherever we go. Other questions, guys? Well, here's what we're going to do. Guys, we are going to take a minute, and I'm going to ask you to break into groups. You may stick with the group that you got randomly assigned to on Friday, or you may choose to go with other folks. But what I am asking you to do is to gather in groups of 3 to 4 and to come up with a name. Because what you're going to do for the rest of today is come up with a name for your group, and you're going to email me. You're going to email me the name of your group, and you're going to carbon all the other members of the group on that email. Once you do that, you may leave for the day. But you can't leave until you come up with a group and a name. Keep in mind, these are the people you're going to be trusting 10% of your grade with. Somebody in this group better be a good writer, somebody better be good at math, and yet somebody who already likes playing the markets, even better. But take a minute and get together in your groups. Once you have email me and the names of your folks and carbon them on the email. So list of names, name of your group, carbon them on the email.